Hey guys, how are you doing? It's the Market Sniper. Yep, let's go and take you into some great numbers on gold. By the way, I just want to highlight, I'm doing this intentionally on a day where I expect a little bit of pushback, and I think there could be a short spell of dollar support coming in. And I'm going to remind you before we delve into the gold mega targets, because I expect a little bit of a possibility of those pushbacks coming down the pipeline to be happening right about now and not too far off future. But I want to remind you of the bridge and the journey and the top of the mountain on the other side whenever there's a possibility of a slight chasm. So here's a couple of reasons why we might rest now. One, and we'll bring in the charts in a minute, but I'll just deal them with fingers and thumbs and talk first of all. So silver is in that $45 to $50 range, which is the third visit, which I believe we need for some element of small rejection in my assessment. When I say believe, it's not a good word. Technical analysis says that is often the case on balance of probabilities, as observed by price behavior generally. So that's the reason why I think it has a higher probability than most people are guessing. Many are thinking it's just going to carry on running straight through 50. I'd actually love it for that to be the case, but I think actually we'll get a little bit of a chip back. So there's that. Number one, silver is in that critical range, the 45 to 49s, 50 range. It's traded as high as 47, which was around about the midpoint of all of that. Second of all, platinum weekly target was made on a macro HVF. Weekly setup on platinum was made. Platinum actually is the biggest performer this year so far. You didn't know that unless you watch this channel. Highest climber of the year to date. Platinum markets. The man who told you. Why did he tell you HVF method? There's fundamental reasons that go with it. Of course there are. But HVF method said so. It's catch-up season and it will come. And I think it's going to be generally from here on in an overperformer, but it goes quiet for a while, does nothing, and then absolutely rips. That is the schizophrenia of the platinum method. So, number one, silver's in the key zone where we expect some form of a rejection. Two, platinum made a weekly upside HVF target. Why you might rest again. Number two. Point number three, gold made a daily upside HVF, which was around the 3,770 range, which we gave you. On an upside, you expect a little bit of overperformance and then potential for some real rejection. Well, you got that. It's trading 3,800 after hitting 3,870, a $70 rejection. We'll look at those charts in a minute. So a daily upside HVF on gold met a target, a weekly platinum met its target, and silver made the 45-49 range. Then there is the beautiful opposite, the avatar opposite. Remember, gold is an anti-fiat, and the greatest anti-fiat that it is most against, that it attacks with the greatest vigor, is the dollar. That's right. Now, the dollar has been capitulatively weak for most of this year, but it landed at key support levels. The Dixie is on a funnel support level. So point number four, after giving you the gold daily HVF, the weekly platinum HVF, the silver at the key levels where we anticipate rejection. Point number four is the dollar index at a support point, both on its macro trend line, the basing ascending grind line, and a horizontal level that was an upside HVF when we called for 112 to be made as a target some time ago after the big events of 2019, 2020. It ran up to 112. Of course, all those very pro the dollar said 120 next, 140 after that. But it wasn't that way. It wasn't that way. So we're going to cover each of those. And then in spite of that possibility and the fact that we may get a little bit of a pullback down on the precious metal short term, we're going to do the most bullish video you can do on gold. Why? Because we don't care about the timing of this thought process right now, but everyone will come and say, oh, called the top, he's bullish, called the top. We're explaining to you why short term actually it could be potential for some pullbacks, and then saying, but, when everyone's getting bearish and says, bubbles pop, this is that, all sorts of crazy language like that. the big numbers that actually will become even harder to believe. And I threw down some big numbers. I said 27,900. And then I said on top of that, on an even bigger scale, 108,000. And we always give justification if we give big numbers. You learned about the $330 here with us. And by the way, we should find that post that went out on no less than the Jerusalem Post. The Jerusalem Post 330. We should find that. They picked up on a macro target that yours truly, Francis Hunt, said in the J Post. The J Post. Fancy me featuring in the J Post. It's almost funny. But anyway, I'm glad to have their support. Glad to have their support, friends. Oh dear, yes. Let's have a look. Let's go and jump on those T things. So let's show you the J Post and that $330, which was when we were talking about silver. We'll be talking about Francis Uncle's 330 silver, the Jerusalem Post. So you can watch this article. I'll put it out on the Twitter, reject, with some powerful metrics to substantiate his call. So given that popularity, we've got some silver stackers obviously out there, that part of the world, that are glad to hear, and they took it to the Jerusalem Post. And there's our charts with our transgender pink in clear prevalence there, and are highlighting in this chart that there might be a small dip. And in this 45 range, this isn't a new take for us, guys. We understand cup and handles and ascending upside HVFs, by the way, and it's quite common. It doesn't mean it absolutely will happen, but it's a probability, and we're sticking our neck out and taking a chance and saying price behavior, as per our study, and consistently can often do this, and it is not being priced in to the same degree that it should. Silver Ape King, glad for him sharing that. That was the chart. There were a couple of other things that went in, but that article, we'll put it out at the end of this take. In fact, let's share it into the links in case you missed it. So we're talking about gold today. We're talking about gold. Let's see if I can share it in the chat. Where are the chats? Too hard to find. Never mind. Let's go back and show you the charts. So what am I going to talk to you about today on the gold side? Let's do these crazy numbers again. And I need to do a couple of things. First of all, I need to teach everybody a little bit of something that you may not know a great deal about. And by the way, I'm not even a particularly good expert in it. HVF method felt superior to me, to Elliott wave in most instances for actively trading and getting a superior tight squeeze. The volatility squeeze is your gift in trading. Beautiful people, I am reading your comments as they come up as well. Is the small risk, highly expansive reward. It is the best. But Elliott wave is some technical analysis that often shows interesting usefulness. And I'm not disrespectful towards it like I am to maths-based formulas on price data, such as overbought, oversold RSIs, momentum indicators, and all of those that do not include volume or anything that leads, only things that can lag. So what you need to learn in the basics of Elliott's wave theory is that there is a 5 wave, and I'm going to give you a very low down simple. Most of it is because that's probably all I've got. I'm not a specialist on Elliott wave. That you have a 5 wave move that can go like this, and typically it's named A, B. That's your up leg, A, B. Your BC is your pullback, and then this leg here, and it's not as I drew it, so I'll draw it again and do a better job this time. So there's your A, B, BC. The next leg is often 61.8% typically, which is a Fibonacci number longer than the first leg. And then you have a 5th leg that is up. So you have over here, you have, let's put it in capitals. This is a macro cycle in Elliott wave to the upside. A, B, then your pullback is the BC leg. And then your largest leg is the CD, which is 61.8% larger than the amplitude from A to B, the vertical amplitude from A to B. You then have a DE correction, and you have your final 5th leg, which often emulates the length of the first leg. So the middle leg, leg number 3, is in fact your biggest. Thank you for the super chat to Mike Packman. We really appreciate you. And we'll give you a question of your choice to answer later if you'll let us finish and continue here. Not that you need the money, but thanks for the streams. I'm poor, but one day it'll hopefully be able to join the Sniper Circle. We look forward to welcoming you. You're not poor, you're rich in spirit and of generosity, and that matters greatly. Keep working at all that you do to improve your life. That is your super big leg. Now I'm going to throw some things at you, opinions and takes. This is essentially largely an American chart pricing of gold in dollars since all of the ages to the modern era, certainly, and well before. And what happened in 1913? Do you remember what happened? The Federal Reserve and the beginning of a fractional banking system happened. It led, very interestingly, to the immediate wars of 1415, which was World War I. In between, after the World War I, which ended around 1516, you then ended up with the Bolshevik Revolution, which overthrew the Tsar, who refused to be part of the World War I. And he was overthrown and families slaughtered in a most demeaning fashion, and many farms were burnt, food supply was spoilt, and people were left to starve. Those that weren't murdered and shot, Orthodox Christians by Bolshevik communists. And we rolled into, after that, World War II with a Bolshevik Stalin in charge, who was equally brutal and killed some of his own Zio friends. Anyway, that all happened all in short succession between 1913, when the Federal Reserve, plus the introduction of taxation. There was no income tax on Americans until that point. You suddenly became an indentured slave who had to pay homage to a banking cartel with payment. You had to make payment and kiss the ring. That's right, that all started in 1913. So the beginning of fractional reserve system. Now I'm going to give you a framing for two scenarios for gold. One scenario that I will do first, and then the second scenario. So let's cover scenario one. Look at that pink line, understand an Elliott 5 wave. That's all you have to understand. And the naming, AB, pullback BC, CD, the longest one, pullback DE, and EF. There's more information you can glean. Go to an Elliott wave site. I'm not trying to give you a master's degree in Elliott wave theory. Just grab that. So scenario one is, this was the last major bull market from the fixed market era to the 800. Everything else, and that was a lengthy bull market, by the way. And if you go right back to the beginning, we have prices. It was lengthy for quite some time. But again, I say the fixed market price was at $20 down here. It then popped to 35 because of the Great Depression and printing of money. Yeah, that stood for the gold value. But if you took the last moment there to there, you called that one gold market. You were at 1980, and we then hit a final low here and very close to there. But largely that was in and around the year 2000, 1999. And then again, quite close, but not quite as low. Let's get those values for you. We're on a 3-quarterly chart, by the way. 3 quarterlies, 3 months, sorry, 1 quarter of a year chart, just so that you're clear. This is gold on a quarterly chart. That 1980 to around about 2000 is a 20-year bear market in essence, because you went to a low. The lowest point here was 252.1. If I test that, it's 254. 254. So the extreme low was there, but you kind of did a double bottom very close to the same lows. And that straddled the dot-com peak financialization of everything. And if you look at gold, or you look at the NASDAQ in gold ounces, that was peak stocks. You haven't been there since. Yes, you had a rally and we're having new bubbles, but in gold ounces, they are no longer at their peak. We are trending down, even to the fluffiest of indicators, never mind the S&P, the Dow Jones, and all the others. So if we frame this as the great, from this period at $20 to 18 as being the bull market for precious metals, and we frame this as the ice cold bear market from 873 to 252, a 20-year bear market. My current position to you all is this that you are experiencing right now is the beginning of another bull market that started in 2000, 99, 2000. And we should frame this entire move in such a manner that everybody understands it. So how would you do it? I wouldn't do it in blue, first of all. I did the bear market in blue. What you would typically say is, well, the first leg, AB, and I'll name it for you, in this new bull that started in 2000, took that long. You then had a blue moment with a minor bear run. We don't want to go letters, we want to go arrows. A bear run here, and then back to bull leg here, which we are currently in now. So given what I gave you on the Elliott, by the way, given what I gave to you, nice to see Northamptonshire in the house. 108K, maybe 10 years away. We will see. I will finish and I will show you. Given where we are AB in this new bull market. That is a C. That was your bear market that took you to $1,045 in 2016, which was when Shanghai Accord happened and the Chinese were super over indebted and all the central bankers came together and made a plan, New World Order, of course, and off they go. In short, if this is the great transition period, let's do this line. You had one bull market from way back when you had fixed money prices on gold. And how could you have fixed money prices for so long? No Federal Reserve. No Federal Reserve, no fractional reserve banking, no inflation or very low inflation, subject to mainly supply and demand. No trickery bankery. That's the problem. You know, all those wars and all that printing and spending more that you get, that all started to happen after 1913, in 1415, yeah, and then World War I, and then Russian slaughter, 17, 18, 19, 20, 21, yeah, and then Weimar in Germany, that's right, into the 20s, early 30s, then World War II from 36 to 45, yep. So let's say there was a bull and a bear market, and this is the new bull from 2000. You are in right now the CD, and D is the letter I should be typing for you, that belongs somewhere over there. And we have a formula for it, thanks to Elliott wave theory, for how that works. Now, our $330 target with an override to 596 on silver all came up and out of an HVF, the most reliable, the best technical analysis approach for getting true targets where a likely rest will take place. This, however, in gold, because it keeps making all-time highs and is squeezing upwards all the time, does not have an HVF, so we are utilizing Fibonacci extensions. How long should this extension from the low be over here at number C? So let's just draw it in for you. How long should that be till its top, and what value? Just for the CD leg, the longest leg. If you're saying 1.618 on the log scale, big time frames, log scale, on the log scale will give you your next resting point before a meaningful pullback. We're going to have a pullback now, I think, but I don't think it's going to be like some people are hoping for a 40% discount on gold. I don't think so. But maybe at the top of CD, you do get 20, 30, maybe even you could get a 40% discount. Again, it's not something I'd be saying, and that's far off in the future. So do you want to know what that D number is? If this is an Elliott 5 leg, one up, pullback, one up, pullback, and a final leg. Do you want to know where that D point is? I'm guessing you do, so let's get straight on with it. Okay, so let's have a look at the Fibonacci. We go back to what we have here. I'm going to remove that and I'm going to take you on to what is known as a Fibonacci tool, retracement tool. In fact, I'm going to get a cleaner chart. I'm going to get one with less lines on it, and I'll draw it on a fresh chart for you, and we'll say goodbye to everything there. Let's just delete. There you go. So we're going from here, the low. In fact, it's there. It's slightly lower there. We're going from here in 99 July. This is how you do a Fibonacci extension. You grab that low. You take it to the high. That is $19.23. So you're going from $252. Brown's bottom. We all know about Brown's bottom, how he sold it on the cheap, knowing the inflation was coming, pretended to be stupid and say, well, we need the money, and sold out Britain's gold to a different name on the clipboard. Yep, we can only guess as to whose name that was. And we run this up to here and we go, okay, we want 1.618. We want a number that represents 1.618. That means it is 61.8% longer and further than the bottom of the bear market on this new 5-leg upswing, which happens to go 61% further. So with drawing that, you will see that I've captured the low there, round about 1,045, maybe a bit closer. Let's run it a bit closer. It was 1,045, I believe. Want to get it as close as possible. It's kind of hard. Okay, we'll put it there on the magnet. That is accurate, 1,046. Where is the 1.618? That number right there, 27,988 for gold. Your CD leg can take you to 27,988, to the doorstep of 28,000. At this time where I'm actually expecting a little bit of a sell-off, I'm telling you about the future to keep your spirits high, because everyone's going to get bearish and say bubble pop, it's all over. We'll get the price 3,819 at the moment, 27,988. Now, if you were to get there in short succession or in long succession, as I'd more likely expect it to be, you are going to do a multiple of 3,818. In fact, we do it the other way around. We're going 28,000. It's almost 28,000. These are not to be exact to the pence. The 161.8 should be met or slightly surpassed. 28,000. Divide where we are now. 3,8. Let's say you'll be able to buy at 3,800. 7 times. 7.36 times where you are right now, which in percentage terms is 636%. You'll make 636%. Almost did it the wrong way around. 636% from here. The other interesting thing about time and duration is as you get deeper into the 5 waves, typically these get faster. That's not the 5-wave we want. The first, the pullback. What tends to happen, the gradient gets steeper than the previous leg, and we are going up to here. So it can often happen in shorter time frame than the first leg's gradient, which could see you making it somewhere there. Then you have a pullback. It can be more volatile, so it can be sharper on the downside. And then you have your 5th leg going in. And we are talking right now about the D, the delta point CD, the 1.618, and it is 27,988 for gold. Right, let's take you to the crazy number, which is very moon boy of me, the 108,000. And what's associated with that? What could be associated with that? So I'm going to give you the same framing for one possibility. We've taken in this example the fact that that was a contained bull followed by a subsequent bear market, and this is a completely new, fresh and beginning new bull market. What I'm going to say to you is, what if What if the real framing, the real macro framing for gold and precious metals is not about something that started in 2000? And for this, I will go back to the Oanda chart with the real history and switch the eyes off and take that fibbo off. What if the real commencement for all of this was the creation of the fractional reserve banking, which was the beginning of debt, over expenditure, debasement of fiat, and the inflation creation? The creation of inflation is governments that overspend. Simple as that. Because they are issuing more money by creating additional debt instruments at an accelerated rate. So, prior to the establishment of the Federal Reserve, 1913, which takes you back somewhere here, you actually had quite a long period of flat gold prices. Flat gold prices means there certainly wasn't a great loss of buying power in your dollar. Gold got the same price. You got the same amount of groceries for that price, and everything was hunky-dory. You're talking from 1833 to 1913. That's over here. I've overdrawn my pink cube. Non-stop period of fixed gold prices. Now, I won't ever say certain things didn't go up. You'd have feasts, famines, droughts, and various other things. But I suspect they went up very slowly because the time the Fed needed to proliferate and create debt, hence why they kicked off 3 wars, 2 world wars and a brutal Georgian Bolshevik communistic implementation on the Orthodox Christian Russians, who were slaughtered en masse to the tune of somewhere between 20 and 60 million, the greatest genocide ever, followed by what went on in China when they introduced communism there. Those are the great world genocides, by the way, not other things that you might be deluded about. Nonetheless, if we take from 1913, let's find it, and say the beginning of debasement began here. You see that? It says 2012. What if the framing for gold is entirely different and it is all one big 5-wave? This is what financialization of everything does to your society. And let me just get it. There's 1911, 1905. Let's stretch it out. What if that's the framing? In short, your Elliott wave starts here in 1913. That is your AB leg. You have a 20-year pullback, which is your BC. And then you are advancing on a C and D leg, for which you are still in the C, D leg phase that started in 2000, 99, 2000. Where does the 161.8% take you, you might wonder? In one giant 5-leg Elliott wave from the commencement of the Federal Reserve in 1913 at a fixed price. By the way, the suppression, once you had a banking cartel, debt and borrowing during these years, is part and parcel for the subsequent overperformance here. In fact, the gradient would look more like these arrows if you did not have the suppression. So we're clearly talking about a market that was manipulated by decree. And the fact it ripped to the degree it did in these eras shows that was the case. Instead of having the gradual bull trend, it had a long flat period by decree leading to a far more vertical trend. And guess what? That manipulation has actually been, in a sly way, around today along your silver and gold markets, and you're about to get the unleashing of being on the wrong side of that manipulation, the shorts, that will bring the same gifts, meaning this CD leg, let's label it for you. Here we go right back to the 1913, and we say A, Nice and big in TG pink. B, C, because this is macro. We may as well go large. And the D, my friends, it ain't even on this chart. It's somewhere in the ether, way, way up there, and I'm about to tell you where. Okay, so let's have some fun and do Fibonacci games again from that point. Now, because of this long period where it took a while for them to create the inflation and the currency debasement, despite wars, civil unrest, and many other things, let's just go to the period where we started to get the unleash. The bottom comes from the last date over here. Oh, it's the 30s. It's the depression. So we do the same thing. From 1913, $20, fixed price of gold. Pull it through to, no, it stopped drawing for me. Let's try again. Come on. It's getting weird on me, sorry. From the fixed gold era and the creation of the Federal Reserve right the way through, So what we have said here, back to our drawings and overlay it again for you one more time, is you have one lengthy AB from the creation of the Federal Reserve, the encapsulation and manipulation of gold by fixed pricing, the sudden melt up once released following Nixon and the Vietnam War, and the decoupling from gold and what it did to the gold price. You have that as your AB leg. All that history, which includes the Great Depression, that was, of course, was in between the First War, the overthrowing of the Russian oligarch, the Russian Tsar, and the Bolsheviks, pre the Weimar Republic, before the Second War, the Great Depression, all the trouble and tribulation that the banking cartel brought to the financial world that scarred so many people financially and killed so many people physically. Let's not forget that point. Then we go from 873 down to the 252 as your pullback leg, and you are now in big letter C, awaiting for D. And where does D come? 161%, 161.8% of the up leg from gold's fixed price pre-hardcore inflation and fractional reserve on a grand scale. There were banks, there were smaller banks, there was some trickery, there would have been some inflation, but not very much compared to the overspending on debt today. Your answer, my friends, is $107,904 gold. The silver guys are going, and I wonder at what gold-silver ratio that might be. Think about that one as well. Think about that one. Let's say it's a hyper-extended trend, and let's be real greedy and say we get below 10. We get single digits, but let's divide it by 10. That right there is $10,000 silver. $10,700 silver. That would be juicy. I think some of you might agree. So that is the Fibonacci extension rules that pertain to 5-leg Elliott. Look, this is one version of technical analysis using Elliott wave theory. Please bear in mind also that there was an immense amount of time from 1913 to 1980. There was a fair amount of time, a 20-year bear market from 1980 to 99, 2000. But everything is shortening. Hey, you might be 90 years old, but you're going to be a rich 90 years old if it gets to 107,904. The key point is, I don't know if the dollar in its same existing form will even still exist in that sense. It'll probably be some hybrid CBD. see that has split. It will be some stable coin, whatever the case. They might have trimmed 3 zeros by then. But this is a worrying statement on fiat and the cost of livings for fiat-based nations all over, and especially the dollar, if this is to transpire. And macro charting works. You just have to give it time. This is big level timing. So I hope you found that interesting. He'll be happy if it reaches 10K. You see, you'll see. Well, if we were allowed to hold it, who knows what suppression? Don't forget, in part of this, there was active state suppression with a fixed price point down here. And we suspect recently there was real derivative suppression following Bunker Hunt, no relative of mine, and the silver $50 run of the 1980s of those billionaires. There was real suppression via derivatives and the financialization of everything, and the Warren Buffett era of the pet rock that you dig out of a hole in the ground and then put in another hole in the ground somewhere to keep safe that doesn't pay you interest. Boy, oh boy, did we have to eat a whole bunch of financialization of everything BS from even your heroes, Warren Buffett. Okay, I'm going to recap the silver for those of you that missed it, and then we're going to shut it down. Shut it down. Too much anti-fiat talk is antiseptic. Okay, let's have a look at this guy again. You have triggered on probably the upside HVF with $330 target right there. And post that, if you take from the lows, the fixed lows, remember silver in these eras, you used to be able to buy things with cents, it was 28 cents. At this point, it was 28 cents. What's the low? 28 cents in 1932, the bottom of the depression. Silver was 28 cents, friends. You're talking about today, $46.17. You've had a little bit of a push into the 47s and a rejection. This flagpole right here, projected here, gives you 596. The upside HVF that I will draw for you will give you the 330 that we've given you. If this is the one leg and the down leg, the 1.618 for silver is up at what goes for gold goes for silver. If this is all one big bull trend with a 20-year correction BC leg, for which this represents your C, let's write those letters in. A, B, and C. The 596 is a bull flag projection, but the 1.618 will give you $14,000 in silver. $14,000. It won't be the same dollar that you're used to. It'll feel like a cent. They probably will have cut some zeros off at that time, but that will be value retention. 14,249. So at 108,000 gold, you would probably have $14,250 silver. And that would still be quite a stretchy gold-silver ratio, by the way. One of them might underperform or overperform. Let's just do it. If both are treated on the same basis and do this. This is all spitballing, macro spitballing, real macro spitballing. It's fun. Don't take it excessively seriously. It's fun. But if you were at 108,000 and you were divided by 14.2 thousand, you would be at a 7.6. That is single digit gold silver ratio, which is part of our predictions. So both gold making its 1.618 at the same time as silver makes its 1.618, you will have fallen from 86 to 7.6 on the gold silver ratio. Interesting single digit gold silver ratio on the 5 impulse the 5 legs up, the 3 and 2 pullback legs, let me rather say, A, B, C, D, D, E, and E, F leg for Elliott wave theory. There you go. Some of the biggest, most moon boy calls you can have in precious metals. 14,250 silver, 108,000 gold. Gold silver ratio 7.6, from down from its current 86 or 75. What's it at? Let's give you an exact one. What's it at today? Gold silver ratio is currently, I think, low 80s. XAU, XAG. 82.7 at the moment. 82.7 on your gold silver ratio. I'll make a few other interesting points while we have the live stream on. There's 852 of you watching, by the way. Thank you. We'll also show you the Dixie and why I say it could just be about to end. We made those targets. Let's recap. HVF daily pattern made. Let's do all the charts for what we said. Okay. Gold, XAU, USD. Daily gold chart, upside HVF. Let's get rid of our fibs. We've had our fun on the big time frames. Let's go down to the daily chart. Let's max this out. Okay, that right there was your target. This represents a degree of overperformance, and you're getting an interesting candle there that pointed. Maybe it's a bit of a rejection. Maybe we'll be right, maybe we're wrong, but it's a red candle. We haven't had too many. From here, 1, 2, 3, 4, 5, 6, 7, 8 green in a row with only one red. 2 red, 9, 10. Then we had this continuation pattern, which was 11, 12 green, but 2 red candles. So that's 4 red. 5, that's 13, 14, 15, 16 to our target greens with only about 8 red candles, most of them very, very small. The possibility now is that you'll face a little bit more headwinds. We'll show you the Dixie as to why. We made this target on the Dixie. On platinum, the weekly time frame. We gave you this on the YouTube channel, and we've been trading this with much glee and joy and bliss. The platinum weekly chart. This is the benefit of HVF method. It gives you lots of signals. Funnily enough, on Oranda, it's yet to make its target. That's really interesting. There's a lot of platinum charts, I'm afraid. There's a future. There's a whole bunch. They vary by broker quite extensively. You do need to know which one you're on. By most of them, you have made your target. On this one, you haven't. Let's have a look at Pepperstone and get the target in the right place. You have made it on Pepperstone. It's a different value, 1590. You will see on Saxo. You made it on Saxo. You're already done. Oranda is literally the only one where I assess that you haven't actually made it. ICE, you've just made it and you are rejecting. You have a look at the futures. We can go platinum, the name, the full, write it up. And we can go the futures over here, NYMEX. That's one. That's probably why Oranda hasn't made it. It's on the NYMEX futures. The NYMEX future has not yet made it, but is very close to making it. Most of the other platinum proxies and brokers, you've made it home. So I think Oranda's based off the futures. Let's have a look at platinum some more. Platinum cash markets, CMC. They're taking the future one as well. So depending which of the markets you made, you've either just made it or you're just about to make it. So I'm slightly corrected. That depends. It depends on your data feed and which market you're watching. So there is still a target outstanding if you're on the platinum future, and some of the brokers are based off the NYMEX platinum future, okay, which could still see a tiny bit more of upside, but close to being done whereafter rests occur. What happened with the silver? Let's go to the silver again. We do need to correct for that one minor period here, 49.81428. So let me give you that draw again, imperfection. And you'll get your 330 target when that shapes up and loads. So let's have a look at some of your comments while we wait for that to load. Come on. What would be the time frame, Francis? It depends which one you're asking for. So all of the 5-leg macros that we did on the beginning on gold are all quarterly charts. Each candle is a quarter. You've got to bear that in mind, and that's a massive time frame. So it's pretty tough to say, but I will tell you that the up legs get faster typically in these momentum moves. So you will have disproportionate gains. You will have disproportionate gains in short time frames, but you've got to count in years. You've got to count in years for those. If we're talking about 108,000 gold and 14,250 on silver, it's not next week, it's not next month, obviously, but you'll be shocked at how much things will change and how. Look at how much we were at below 1,000. We'd never made the 1923 high. That was 2011. Then we were stuck at 2,000 for an extended period. Now you're on the door of 4,000. Let's see if we can get that silver draw. Let's have a look at some of your other questions. America won't always be settling price. That is true. By the way, this volume by price here that runs through the middle of the funnel is very comforting for the structure of this draw. This is typically what should happen. Alignment where the greatest volume throughout is in and around the midpoint of your funnel. This is a very high quality setup by our methodology. So I would expect some rest, and 330 is some way away. We have just run the first interim, and we're also in that special price zone where the cup and handle drawers, which are the most common technical analysis posts on silver, are drawing. And I will highlight for the quarterly, you are already at the highest quarter if you close tomorrow at these levels or near. We have never closed a quarter higher than that. We have never closed a quarter higher than that, and we are substantially higher, 37, which is quite amazing given that you traded virtually 50. You not only failed to hold 50, you failed to hold anything in the 40s, and you didn't even make it 39 or 38. You're at 37 by quarter end. That's Mr. Slammy. That's your manipulation that gets paid back in spades when you dip back. I suspect this time at a candle body level, we will be higher, but we will still face some resistance. So that's your silver chart. But the upside HVF is far more reliable for your targeting, and it's $330. Hurry, buy all your shorts, bullion banks. We must cover up the truth, says Trevor. Would you sell your house if you had a 2% fixed rate bond loan in Denmark? I cannot give advice to people about whether they should sell their houses or not. You need a place to live. I'm non-advisory. What I would say is only what I would do. I will be overweight precious metals, distinctly and violently overweight precious metals on the basis of that. I wouldn't be over long property, which has leveraged bankers and other things that they would love to steal from you and create and form, put you as a tenant in your own home. So I would avoid the tertiary extractors and borrowing, even if it's in your contract. Who knows what's in those terms, in how they might beguile you. Interest rate spikes are one of the perfect way to ensure that somebody can't be a payee on their mortgage. A good person can't. And they need the good people out. They hate you. They love the welfare people that are already entirely reliant on state. They captured. They vote for the welfare state always. They hate you independent, self-reliant people. And if they've got a little bit of banker leverage on you, that's what they're going to pull. Pay your mortgages off, get your full title deed in your name, say goodbye to your relationship with your home and your bankers. Separate them. Overweight metals, correct, Neo, violently overweight metals. What else have we got? Is this the decade? Well, I feel time-wise that it is. Now, I mentioned the dollar index as to why we could get some technical pullback, and I will recap this because it's quite important. Because everybody's going to call, yeah, look at the guy who did the biggest moon call straight after. Maybe there's a pullback on the precious metals, like a topping indicator. You know, our friend, what's his name, Kramer. You'll get a bit of that. So I want to put this in proper perspective. That said, the dollar, that is not a great candle for the quarter, and the quarter is nearly over. That's a weak response to two brutal selling quarters. So it's not like hey, the dollar's awesome, it's going up, it's a king. It might bounce, get some support for a while, have a minor drift up, and then I think it gets set up for some more selling. So I don't think you're going to see much. I think people waiting for major pleasure to befall them on the dollar might be greatly disappointed. The trade is debt-based collapse. That is precious metals. It's a debt-based collapse, guys. You're going to keep hearing it from me until I've brainwashed you into saying it in the middle of your sleep. It's a debt and fiat-based collapse. Remember, they go together. Debt and fiat-based collapse. Who's issued the most debt? Who's been paying on IOUs of treasuries and USD for nations bringing them goods? Who's been doing that the most? The hegemon falls the hardest. Here's your core orange days on the Dixie. Topping out at the 100 there, another test at the 100. You got through the 100, you're at top of the range, you sold off. Then you came up, big rickshaw boy, almost a shooting star on the 100 run. This is pre the CV19 events. Then the print for everybody, the weakness of the dollar, key candle there. Let's do it on a weekly. I think it's a weekly time frame that I had. Let's make it fortnightly, cut it in half. Maybe monthly is the best. And then you had the big upside HVF setup here. You had a huge upside HVF setup from this low. We've drawn this many times. We'll draw it again. This was when dollar was expected to be strong. I'll show it to you in a second. We need to make a change. By the way, that drawing tool, part of the many tools that you'll have access to when you become a member in the HVF community, trading technically to build your wealth. Let's give that a little refresh. Come on, come on. It takes a while to load. And come on. I don't know why it's slow today. Let's do it one more time. Tell us what your targets for gold will be in 5 years' time. Give me the 5-year mark. You should all still be hoping to be alive in 5 years' time. I'm not sure the Bolsheviks will have completed their master plan then. Let's get it in there. Mode 2 inflection points per 1 bar. Let's see it go. What is your top line number? Oh man, why are you taking so long? There we go, finally. Okay, This is the dollar index, and this is why we say there is a pause on the dollar weakness trade. This is a monthly chart. Terrible month, worst month, even worse, worst month of them all. An attempt to rally, squashed. You break into the funnel. See the green line and the red line there, guys. That's after making the target, by the way. You see the high end of the channel range. This was our call when dollar long. Uppity, 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 up. There's your take. It wasn't 120. It was always fixed. It was 112,975. Down, down, down. You supported on 100. You supported on 100. 100 gave up. You are now sitting in the funnel. You try to get away. You're being trapped between the funnel and the 100. It's trapped between two layers of hard rock. The 100 level got rejected on the 100. What was previously support turned into a degree of resistance over here. And now you're supporting here. Bit of a hammer. And don't forget this line. A beautiful intersection. Isn't it beautiful and coincidence that the basing ascending grind line and the funnel are here, and the dollar has come down and set up a hammer on that day. Another key Dixie day in orange for you after that. Okay, so that's why we might get a little bit of a rally. I don't think there's any chance that it rips at the same pace it came down. I think you get weak, soft rally. You play with 100, you get a bit above the 100 again for a bit, and then longer run, outside of a demand-destroying event, I think you fail out of this channel. This channel has been in force for an extended period. Often, by the time everybody has noted and drawn the channel, it's usually about ready to fail. And I'm seeing a lot of people suddenly now have got this drawn on their charts. The base low of the dollar was at 70 on the Dixie. Believe it or not, it needs to go really low. It need for the gold holdings they claim to have, listen to how I say this, which are today worth around $1 trillion, they would need a 37x in price to have an asset to the same value of their current debt, just to be net zero, the US. And that valuation is around 142,000. To no longer be broke and to be flat coin square, you have an asset that matches your debt. You need 142,000. So people that aren't used to big numbers better start getting used to them. And by the way, all your enemies that are stackers, that have less debt than you and have tons of gold, like China, probably far, far more than America, they become super rich at 142,000. You're skint. You're just like plain skint. You've got 10 grand in assets and you've got a 10 grand bill on your credit card. You're zero. That ain't good. It just means you're not in the red. You're a zero. So bear that in mind as a technical situation. And if you have 142,000 gold in dollars, again, another scary big number, were that to happen, the amount of goods you buy with $1 will be absolutely menial. You should view that dollar as a fraction of a cent, which is basically what has been happening on a slow basis since the introduction of the Fed. Hence why I went back to the introduction of the Fed to do the Elliott wave analysis as we've done it today. However, right now, short term, on a more short and medium term, you may not get any further weakness for a spell. Typically what I would expect, rising wedge to break through the 100 mark as a technical exhaustion, and you break the rising wedge, you break the bagel, the basing ascending grind line of, I don't know how many years, 2008 all the way to today, which could end up happening in 2026, for example. That means it will be the better part of 18 years in the break. And then you get through this funnel with momentum. You break funnels with momentum always. You form up structures, you wind up, you could do this. I discussed this with my community in an update earlier today. you could do that. You create a little inverted setup to smash through the seam of support that you've been above ever since 2022, despite printing 7 trillion, which was part and parcel of that crash to the bottom. And then you rebounded to the top. And since then, I think you could break. That's how you could go down. So it's not necessary. It's not a bull market dollar. It's just no longer a straightforward, straight down. A little bit of rallying, a little bit of support, bit of chop up, bit of chop down, not making a new low for a while. And when you do, getting support in this space here. Okay, there's your technical setups for today. What do you think of them targets? Do they make you happy? Do they make you sad? I think they should make you happy as a gold person, but you should be sad for the world that lies on the other side of that and all the other people that have no chance of keeping up unless they have precious metals. The best thing you can do is to drive people to the links below, pure gold, to buy gold. Anywhere in Europe, UK, you can use our links below for ITM trading to buy in the US. Bullion vault, internet gold, and then sell up once you have a meaningful amount and have delivered. You are saving lives because the cost of living destruction for those that don't do this is going to be diabolical. That's the real truth. And you say thank you to our channel by forwarding the links. They'll pay the same price that I pay, as do you, on all things precious metals. They can buy silver and platinum too, which I suggest they also include on a non-advisory basis, on the basis of my assessment in terms of what I am doing for myself. Again, non-advisory. This is a debt-based collapse. Debt collapses, fiat collapses. Fiat collapses, stuff you buy costs tons of notes. That's what happens. Till next time, thank you for watching. We've got 979 of you. We appreciate it. Don't forget to click the link below if you wish to become a community. Great opportunities, by the way, on maximizing the miners. Upside HVFs on lower time frames, 4 hours, dailies, weeklies, will continue to be thrown down, just like the gold daily that gave us the targets we spoke of, and the very clear-cut, strong move. Just look at that again to see how easy. This is the way you can easily trade with leverage, in our opinion, when you have a single-minded market that moves like that in your favor. Have a look at that. That's what it did. It wasn't doing this. You get involved early there. We were early on that move. Was it the break? We were early and wrong. We took a small loss. All of this straight to there. The line of efficiency, the angle, the speed, the number of daily closes. Look at this on a weekly chart, friends. This move on a weekly chart, let's just do it for you and pull it through. There was not a single negative closing week. Can I just make this point for you? You had plenty before, negative week, 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 negative week. You get it, negative week. From when we got in till when we closed, we had 1 positive week, 2 positive weeks, 3 positive weeks, 4, 5, 6 in a row positive weeks, and you're probably getting a 7th right here. In a row. That's comfortable trading. That means the price on Monday, when you check the markets open, to what it is on Friday, you've made money. And the next Monday, to the Friday of that week, you've made money. And not once, not twice, 6 going on 7 times, back to back. That is the gift of HVF trading. Comfort, steady, strong, violent in some cases, moves away from your entry on a very tight stop. We optimized tight, super, super tight on this. We gave you this trade. Look at the length of that candle to make that. You went at one point from 3,000, sub 3,450 to well over 3,600 in a single week. $150 on a leveraged trade where you had managed risk and loss. That's what we focus on doing. Accounts are at all-time highs across the board, doing the same trade. This was our best opportunity. Note the selling wick here now, It's been walked back. It's a little bit more blow-offy now. A little bit more blow-offy. Time for another rest. Then you'll get negative week again, negative week, hot, cold, hot, cold, 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 hot, hot, cold, cold, cold. You can't trade chop. Not in terms of direction trading. This is the gift of HVF method. That is why you go to that there link right there and you book and you say, I want in, and I want in big, borrowing a tiny bit during these moments only. That's what HVF method gives you as a gift. Okay, friends, that was it. I look forward to talking to you further. By the way, the platinum, before we finish, let's just show you the platinum weekly one in the same way. How did it go with platinum? We gave you this trade, but you don't have the conviction. You don't have the conviction because you haven't studied the method. You haven't internalized it. You've just seen a guy far away with an internet connection. Some guy actually said occasionally sounds arrogant. One guy, been speaking to a lot of people. It's been fun catching up with everyone. I don't mean to sound arrogant. If I do, I apologize. But we've got a great tool and we're happy about talking about it. And, we're helping a bunch of people maximize their growth in what is reset times. That's your setup. Let's get it straight. Bam, bam, bam. And not one. Do it like that. There, made target. CFDs on platinum. Now, on that monthly basis, massive month, huge month, 4 big months, and you're home, 1 month where you were mildly down. And where did it happen? You guessed it, at the place where we said, don't watch during this period until you've left it. You got your warning. Leave it. Don't watch the chart. Go play golf. Take some Ryder Cup fans with you to swear and throw beers at your wife. Yeah. Anyway, that's it. No more jokes. I'm done. Thank you for watching. That's the method. That's what you need. There's a real opportunity to build wealth. To not build wealth now in these times is to be part of that polarization on the top of Greenwich Hill, the video that's got some of the highest watch views we've ever had. This is a polarizing event. Poverty, struggle, tightness, hardship versus potential wealth, affluence, a greater degree of comfort in a time where the masses are all going the wrong way. And that's why I say, spread the word here with this YouTube. We need to save as many people as possible. I want retail. I want ordinary people to be major stackers. I don't want the corporates, the home offices, the high net worth individuals, and central bankers to have shored up their balance sheet for what's coming. I don't want them in the lifeboats of the Titanic. I don't want them and then waving at all the normies and the retail guys. Bye-bye. Oh, that hull's sure gone vertical. Looks like you're going to have a real icy swim. Too bad all the boats are gone and we're on the radio saying, no, there's no crash. Don't worry. Don't come. It's not sinking. Bye. Have a nice life. Hope it turns out okay and that you don't turn into killer whale food with a block of ice cube around you. No, that's what went down. You want to save them. You want to save ordinary people. Get them stacking. And even if they squeeze, they must stack. Every last penny.